Hello, this is a video presentation on 11 ideas of international tax planning, which we with our team have developed to help international businesses to adapt their structures to recent tax developments. My name is Viktor Kalgin, and I have been working as a tax consultant with international companies for 20 years already, and I help clients to adapt their structures to ever-changing international tax environments and help companies maintain tax efficiency of their international businesses. This is what I do, and in this presentation, in the context of recent tax developments that affect international structures, I present 11 ideas that can help to adapt and maintain tax efficiency of international structures in the context of these planned changes. The presentation will be in 4 parts. The first part will be about international structures with assets in Russia, and there will be 4 planning ideas how to improve or at least maintain tax efficiency of international structures with Russian operations. The second part will be on international structures with assets in Kazakhstan. Then we will move on and discuss 2 ideas on structures with assets in Kazakhstan. On structures with assets in the United Arab Emirates. That will be the third part. And finally, in the fourth and concluding part, we'll talk about other countries that we see in international structures. This is the plan. And let's move on to the first part, the first section, with 4 planning ideas for businesses with assets in Russia. The first idea is related and is connected with the expected increase of the profits tax rate that's going to be 25% starting 2025, while currently in 2024 it is 20%. And it will not only affect operating profits of Russian companies, but it will also apply, the increased tax rate will also apply to some cross-border payments. The most common types of such payments that will be affected are royalties and interest. So currently in 2024, royalties are, as well as interest, are subject to 20% withholding tax. Next year it's going to be 25%. And obviously this calls, this makes, in this context, it makes sense to consider payments of royalties and interest before the year ends, while the 20% rate is still applicable. And even if reduced withholding tax rate is possible, and despite Russia postponed or cancelled double tax treaties with many countries, still there are tax treaties where reduced withholding tax rates apply. For example, Russia-Hong Kong double tax treaty allow to reduce withholding tax rates on interest from the domestic rate, which is currently 20% to 0. It allows to exempt interest paid from Russia to Hong Kong from withholding tax. Still, Russian tax authorities, they often scrutinize reduced withholding tax rates. It's not uncommon for the Russian tax authorities to challenge tax treaty rates, which means that even though reduced or exemption or reduced withholding tax rate may apply next year, and it may not result nominally in the increase of the withholding tax rate next year, still the amount in question, the domestic rate, which will be increased, will affect the magnitude of tax risks associated with application of treaty benefits. This is why even if treaty benefits apply, payments until the end of 2024 are more beneficial than payments that are subject to increased withholding tax rates, such as royalties and interest, next year and going forward. So this is the idea. Just to note that not only interest and royalties will be affected, but some other types of cross-border payments as well. For example, sale of immovable property, as well as sale of property-rich companies with immovable property in Russia. Also, some other types of income, including other income, which is a broad category that sometimes is applied to various types of income which do not fall under other categories. This is why, again, the increase of the withholding tax rates, which follows the increase of the nominal tax rates, profits tax rates in Russia, will affect different structures, which, again, in which context the idea to accelerate payments subject to the increased withholding tax rates makes sense. Not all cross-border payments are going to be affected. Notably, international shipping is still subject to 10% withholding tax rates. Intra-group services are going to be subject to 15% rate, as well as dividends. The domestic rate for dividends from Russia to non-Russian parent companies is going to remain at the level of 15% next year. Okay, so this is the first idea. Next idea relates to the so-called 5-year tax exemption for individuals, where it is currently possible to exempt income from sale of Russian as well as non-Russian companies for Russian owners, to exempt this income from personal income tax completely, as long as this is a long-term investment and the asset, the subsidiary, the company which is being sold, is owned by the individual for more than 5 years. So full exemption applies currently in 2024. Next year, the scope of application of this exemption will be narrowed. And first of all, it will be limited to 50 million rubles, which is about $500,000 currently. And it will not go into apply to non-resident individuals. This is why if it is planned in the short term to sell a Russian or non-Russian company which is subject to the 5-year tax exemption, it's better to do it before the year ends rather than postponing it to the next year, where the income is going to be exempt only within the 50 million ruble limits, or is not going to be exempt at all if the individual who sells the subsidiary is a non-Russian tax resident. So this is a simple idea. This 5-year exemption also works in intra-group restructuring. And it's interesting that a similar exemption applies to Russian companies, Russian legal entities. And this exemption is not going to be reduced, it's not going to be narrowed next year, which calls for an idea of restructuring of assets using the 5-year exemption and bringing them from the individual level to the corporate level, and applying at the same time the exemption. So, for example, there may be a Russian subsidiary of the same individual that buys the subsidiary from the individual using the 5-year exemption and builds up the cost basis from the acquisition of the subsidiary, and also receives it also can apply the 5-year exemption going forward if the investment is going to be long-term, and provided that the exemption still remains for companies. One important thing to note is that income for individuals is subject to tax on payment on cash basis. This is why not only it will be important to sell a subsidiary, to sell the assets this year, but also to receive payments from the sale until the year ends. It can be cash payments, some sort of a set of mutual obligations, but it should be done until the year ends, which complicates the restructuring or the sale of assets, but it's an important consideration. Okay, next idea. Contribution of assets by individuals to a Russian limited liability company before the year ends. Here, what's important to know is that in Russia, for individuals, there is a concept of so-called material gain, where if individual receives currently shares or other securities in exchange of assets, or just below the market level of these shares or securities, then income is imputed for personal tax purposes for the individual, and the individual have to pay tax on so-called material gain. And the most, or at least quite common scenario, is where assets with historically low cost basis are contributed to a subsidiary by an individual to its subsidiary, and in exchange shares are issued. And if the assets being contributed appreciated in their market value, and the historical cost of these assets is low, then the material gain arises as a difference between the current market value of the contribution and the historical cost basis of assets. Currently, until the end of 2024, only this material gain, this concept only applies to issuance of shares and other securities, while next year it's going to apply to participating interest in limited liability companies as well, which means that contribution of assets into Russian limited liability companies is going to be subject to the same concepts, and material gain can arise. And the conclusion is that it's a good idea not to delay such contributions until next year, and to do the contribution this year if, again, the company that receives the contribution is a Russian limited liability company. The assets that are being contributed have appreciated in their market value, and therefore next year material gain arises, while currently this is not subject to material gain because it doesn't apply to participating interest in Russian limited liability companies. This is the idea. There will be other solutions next year after this concept applies more broadly to contributions or to issuance of participating interest in limited liability companies. For example, it can be considered to contribute assets into so-called contribution, to make a contribution as a so-called contribution into property. There are other downsides, but the advantage would be that such contribution is not associated with issuance of shares or increase of participating interest. It's just a, let's say, just a contribution without issuance of additional capital, informal contribution sometimes it's called. But there are other disadvantages. For example, cost basis is not maintained in this case, and the company that receives such a contribution, although no material gain arises for the individual who contributes assets, unfortunately the cost basis is lost in this case. So there will be other solutions next year, but they will have their own disadvantages. This is why until the year ends, it may be a good idea to make a contribution into a Russian limited liability company to maintain the cost basis and to avoid the so-called material gain and taxable income for the individual who contributes the assets. Next and final idea number 4 in the Russian section is directly related to increase in the profits tax rate, which is going to increase from 20% to 25%. Which means that costs are going to be more valuable next year, while income and profits are going to be more costly. They will be associated with higher taxation compared to this year, which will mean that it may be a good idea to postpone certain types of expenses until next year and to accelerate the receipts of income this year and receive this income in 2024. However, it should not look artificial, and attention should be paid to anomalies in income recognition and expense deduction. And this was specifically addressed in a recent interview of the Russian head of the Federal Tax Service, Danil Yegorov. He said that the tax service will closely monitor the situation and look for anomalies and challenge unjustified, let's say, redistribution of income and expense between the years when the tax rate changes. But still, where it is possible and justified from business perspective, this idea can be considered, especially if we talk about recognition of losses, because strictly speaking, losses, to deduct losses from current profits, it's a right of the taxpayer rather than his obligation, which means that it's not necessary if accumulated losses exist and 2024 turns out to be profitable. It's not obligatory to recognize losses and increase the tax base in 2024. It may be a good idea to postpone recognition of losses until 2025 and deduct them. Then, when the value of such losses as an asset is going to be high just due to the increase in the profits tax rate. Okay, let's move on to the next section about Kazakhstan, where we talk about just one idea, which is nonetheless important. Idea number 5, postponement of dividend distribution from Kazakhstan until 2026, not 2025, 2026. This idea relates to the planned tax reform in Kazakhstan. And initially this summer, a new version of tax code of Kazakhstan was published, and the expectation was that it's going to apply starting next year. It looks like it's not going to happen, and the discussion will continue in 2025, but still there is a good chance that there will be changes in tax legislation of Kazakhstan from 2026. And there are, in relation to cross-border payments, there are some positive changes, and that includes reduction of withholding tax rates for dividends in case if the parent company owns a share in the subsidiary in Kazakhstan of 25% or more, in which case the domestic rate of 15% reduces to 5%, which is a welcome change, and which justifies the distribution of dividends after this change takes place. Obviously, there are no guarantees that the change will be introduced as it was planned. It may be modified next year, but hopefully it remains, in which case dividend distribution to parent companies with significant share in subsidiaries in Kazakhstan will be subject to the reduced 5% withholding tax rate. It's especially important in a situation where in Kazakhstan it's not uncommon for the tax authorities of Kazakhstan to challenge reduced withholding tax rates, treaty benefits, and there are many treaties that Kazakhstan has concluded with other countries that allow for the 5% withholding tax rates, for dividends, but unfortunately it doesn't always work. For example, for passive income, a condition was introduced a couple of years ago to apply the reduced withholding tax rate by the tax agent, by the company in Kazakhstan that applies the reduced rates. The condition was and still is to make sure that this income is taxed at rates of 15% or higher, which is not always achievable or even hardly achievable for dividends, which are very commonly exempt for parent companies. And formally, the reduced withholding tax rate for treaties does not apply, cannot be applied by tax agents, and it can only be refunded. The difference between the domestic rate of, let's say, 15% and the treaty rate of 5% can only be refunded from the state, which is difficult, and at least it's not easy and takes time, not always successful. Which is why the reduction of the domestic rate to 5% is a welcome change. And also, if changes take place as planned, as the draft tax code that was published will apply, then the subject to tax rule for intragroup payments of passive income is going to be abolished, which justifies another postponement of payment of other income which otherwise are not subject to the reduced withholding tax rates due to this subject to tax criteria. Okay, this is the idea. Next, we are moving on to the section for structures with assets in the United Arab Emirates, and there are two ideas here. Idea number 6 is assessing the prospects of, and increasing the chances of applying the 0% rate, corporate tax rates in the United Arab Emirates. As many of you know, this year most companies in the United Arab Emirates will have their first year where the new corporate income tax rates, corporate tax rates, applies to profits of companies in the United Arab Emirates. And unless the company is registered, does its business in one of the free trade zones and fulfills some other conditions, the company should pay a corporate tax rate at a rate of 9%. This is the standard corporate income tax rates in the United Arab Emirates, while companies in free trade zones which qualify for the 0% rates can exempt their profits from corporate tax. And the end of this year and the beginning of next year is a good time to assess the prospects of applying the 0% rate. So, for example, companies in free trade zones, they have to qualify for the 0% rate. They have to have proper substance. They have to receive so-called qualifying income. They should not elect to be subject to the normal 9% rate. They should comply with the transfer pricing principles and rules, including compliance with prices in intra-group transactions, as well as some reporting requirements. They should not receive, such companies to qualify for the 0% rate, should not receive non-qualifying income or income which is, well, any bad income that doesn't allow them to apply the reduced the exemption. And this income can only be received by such companies within very strict limits of 5 million dirhams or 5% of their total revenue, whichever is less, which is a strict limit. This is why income of companies that wants to qualify for the 0% rates should be closely monitored, and bad income should be avoided. And finally, companies should audit their financial statements in order to apply the 0% corporate tax rate. And even if companies do not qualify for the 0% rates, there are still certain exemptions and elections that can be made to ensure that companies do not overpay their taxes. For example, investment income of dividends and capital gains can be exempt even for regular companies that are otherwise are subject to 9% rates, can be exempt if so-called participation exemption applies. In certain cases, it's possible to make elections which postpone recognition of taxable income. For example, foreign exchange differences can be subject to tax on realized basis instead of accrual basis. And all this should be planned and modeled in advance. There is still time to make decisions for companies which have financial year that coincides with the calendar year. There will be 9 months in 2025 to calculate the tax, make certain decisions, and prepare their first corporate tax return. But still, time is running, and maybe the end of 2024 and the beginning of 2025 is a good time to assess how tax is going to be paid in companies in your structure in the United Arab Emirates. Next idea, number 7. It's an idea about transferring of trader to one of the designated zones. Historically, trading companies were used in the United Arab Emirates to ensure tax planning of international trading activities. And historically, these traders didn't pay corporate tax before it was introduced a couple of years ago, in which case certain tax planning and tax efficiency solutions, certain improvements of tax efficiency of international structures were achieved. Now it's more difficult to to use a trading company in the United Arab Emirates and qualify for the 0% corporate tax rate. And there are basically two options. The first option is to have a trader in any free trade zone and fall under the definition of trading of qualifying commodities. If a trading company in the United Arab Emirates receives income from trading of qualifying commodities, then it can, subject to other conditions, can qualify for the 0% corporate tax rate. But this narrows down the range of income, or types of income, or types of commodities, types of goods that are being traded, to those who fall under the definition of qualifying commodities. One of the requirements is to make sure that these commodities are traded on one of the recognized stock exchanges. But still, for example, traders in Dubai, in DMCC, one of the free trade zones in Dubai, they often trade commodities, which follows from the definition, from the name of the free trade zone. DMCC is Dubai Multi-Commodities Center. That's the first option. The second option to qualify for the 0% rate for trading activities is to fall under the definition of distribution of goods or materials in or from a designated zone, which on the one hand expands the types of income that the company can receive. It can trade not only qualifying commodities but other goods as well. But the company in this case should be located in one of the designated zones. And for example, DMCC is not one of those zones, which means that traders can be carefully located in one of the designated zones. For example, Java is probably one of the most common designated zones in the United Arab Emirates. In which case, there is no requirement for the goods that are being traded to be traded on one of the recognized stock exchanges. There is another requirement. These goods should be sold to manufacturing companies or to companies that will resell these goods. So no end customers should be paying goods from the distributor, from the company that is located in one of the designated zones. It's not obligatory to bring goods into the territory of the United Arab Emirates, although it is possible, in which case they can be stored in a bonded warehouse with no VAT or with no VAT and customs duty applicable to such imports, in which case the United Arab Emirates and one of the designated zones will work as a logistic hub for the international trading company. Okay, so it is possible, and if your trading company doesn't fall under the definition of trading of qualifying commodities, it can be located to one of the, it can be moved to one of the designated zones and enjoy the exemption, the 0% corporate tax rate. Okay, next idea. Next idea or set of ideas relates to other countries, and idea number 8 is new levy in Mauritius. This year, a new corporate climate responsibility levy was introduced at a rate of 2% in Mauritius, which first of all affected companies with operating income. So companies that receive operating income subject to 15% corporate tax rates in Mauritius, the regular, the domestic, the regular tax rates for operating profits. Now it's increased effectively to 17% after the 2% levy started to apply, which reduced the tax efficiency of structures in Mauritius. Moreover, at least some types of investment income, like dividends and capital gains, can be subject to this new levy, corporate climate responsibility levy, which calls for an idea to at least assess the tax efficiency of historical structures in Mauritius and potentially move them to one of the new locations where the tax burden is lower. As we already mentioned, in the United Arab Emirates, the tax rates, the normal, regular tax rate is 9%, which is lower than potentially applicable 17% rate in Mauritius. In Cyprus, for example, the rate is 12.5%. So it's a good idea to consider other options if your structure with Mauritius company becomes tax inefficient. And this brings us to idea 9, where we assess the feasibility of conducting business or moving a company to one of the countries of the Persian Gulf. And there are fewer and fewer companies in the countries in the world where the corporate tax rate is 0, where it is possible to exempt profits of companies from corporate tax rate. But there are such countries in the Gulf, in the Persian Gulf. One notable example is Bahrain, where there is still no corporate tax for regular businesses. Only companies and income in hydrocarbon industry are subject to tax. They also, next year, they introduced the minimum 15% tax for multinational companies, for companies in Bahrain, which are subsidiaries of multinational companies with consolidated revenue of more than 750 million euros. But still, for many companies, it is possible not to pay tax in Bahrain next year, which makes this this country attractive to structure, for example, trading operations or other activities to enjoy the exemption from corporate tax rates. And there are other countries in the Gulf region where it is possible to achieve the 0% rates on companies' profit. We already mentioned the United Arab Emirates, where in one of the free trade zones, and provided other conditions are met, the applicable rate is 0. There are other countries as well. Oman and Kuwait are examples of countries in the Gulf region where in special zones, under certain conditions, it's possible not to pay corporate tax on operating profits of companies in these countries. Next idea relates to applicability of exemption in relation to interests in Hong Kong. So first of all, in Hong Kong, Hong Kong is known for its special tax rules that allow Hong Kong companies not to tax income that is considered offshore, that is considered to be received outside Hong Kong, in which case taxation and income tax rates of 16.5%, which is the nominal rate in Hong Kong, does not apply if to types of income which are not to categories of income which are not considered as received in Hong Kong, which are considered offshore. Starting 2023, Hong Kong introduced another set of rules for passive income to avoid aggressive tax planning, and if such passive types of income are offshore, they still have to qualify for additional conditions in order to be exempt in Hong Kong. These rules are called foreign source income exemption. They apply to interest, dividends, capital gains, and royalties. So it's still possible not to tax these types of income, but some other conditions were introduced. But still, there are two sets of rules. First of all, it's important not to fall under the definition of onshore income. It's important to receive income offshore, and then for passive types of income to qualify for the exemption, for the foreign source income exemption, to exempt passive income from profits in Hong Kong. And it looks like the Hong Kong tax authorities, they tend to apply a stricter view in relation to exemption and qualifying of income as offshore. And for example, this year news emerged that now the Hong Kong tax authorities, in order to qualify for one of the definitions of offshore income for interest, they tend to say that historically what was called simple loan arrangements, which is one option to qualify income as offshore for interest on loans, they do not apply to certain situations, such as, for example, loans that are extended from borrowed funds, which narrowed down the scope of application of this concept simple loan arrangements, which was easy to be met historically. It was sufficient in order to qualify for the offshore type of income, for interest, to receive this interest on non-Hong Kong bank accounts, in which case this income was considered offshore. There were still conditions to exempt this income under the foreign source income exemption, but these conditions were relatively easy to meet, which allowed to exempt income from in the form of interest from taxation in Hong Kong under relatively simple conditions in many cases. Now, due to this more strict view and the depreciation of income as offshore by the tax authorities in Hong Kong, it's important to review historical structures and to make sure that income still falls under the definition, interest income still falls under the definition of offshore income. In some cases, it requires more careful analysis and more complicated set of rules to be followed. So, for example, another exemption will be based on the so-called operating test, where decisions in relation to loans provided by a company in Hong Kong, decisions were made outside Hong Kong, which on the one hand allows to qualify this income as offshore. Still, despite another category of exemption, simple loan arrangements does not apply. But at the same time, it makes it more difficult to meet the economic substance requirements, which in a way contradicts the principle of decision-making outside of Hong Kong. Economic substance requires decisions to be made in Hong Kong, in which case the second set of exemptions, foreign source income exemption, where it's sufficient to meet the economic substance requirements, at the same time they're going to be more difficult to be met if this other type of exemption for offshore income is relied upon for interest income. Okay, so the conclusion here is due to this stricter view of the tax authorities in Hong Kong in relation to interest income, historical structures should be reviewed and assessed, and maybe restructuring should be implemented in order to secure the exemption of interest income in Hong Kong, or to maintain the tax efficiency by moving interest income elsewhere. And finally, this year, 2024, is going to be the first year when, for many countries, so-called Pillar 2 rules are going to apply in terms of minimal corporate tax rates of 15% to profits of multinational groups. And in European countries, most of European countries, these rules were introduced, which means that if the ultimate parent company in your structure is located in Europe, then in order to avoid tax inefficiency, you should plan your profits, distribution of profits between countries and effective tax rates in different countries properly, and use various selections and tax assets in order to avoid tax inefficiencies. The good news is that these rules, these minimum corporate tax rules, which in many countries start to apply starting 2024, only apply to companies with consolidated revenue exceeding 750 million euros, which is a relatively high threshold. Not every our clients exceeds this threshold, but still those who do should monitor carefully their structures and probably already start modeling their tax burden in the new conditions, in new environments, and try to use various selections and solutions, tax assets, in order to avoid tax inefficiency. One of the examples which I came across in my practice was to use accumulated losses in order to avoid additional tax being paid at the level of the ultimate parent company. Okay, and to conclude, first of all, my contact details. You can reach me out by email at vkalgin@globalaimcons.com. My phone number is +7 777 032 3159. WhatsApp or Telegram, feel free to reach me out there. Second, this presentation can be downloaded from our website at globalaimcons.com/materials. And finally, I'm never tired of saying that each situation is unique, and these ideas, they should not be implemented blindly. Specific facts and circumstances and risks of each particular situation should be considered and properly addressed. And this is what we help our clients with, and I will be happy to discuss your particular situation, help you to implement these and other ideas to help and to achieve tax efficiency of your international structure. Thank you for your attention, and let's stay in touch.